Hooty hoo, all my stock market gamblers. Welcome today. I'm Tall Mike. The stock market's open. Stock market was down early, went up, and now we're kind of flat. Okay, so why the volatility today? Well, Jerome Powell was talking in front of the Senate today. What do you have to say? Well, he had good news for us. Anyways, the consumer is strong and there is no recession in sight. Isn't that incredible news? Oh man, you just can't make this stuff up. Now, part of me thinks he actually believes that. That's kind of funny to me, being an economist and all. Well, today we have a market that's very volatile, right? And we had that big up day yesterday. Now, a lot of people are saying yesterday's big move up was a dead cat bounce. Now, I don't think we're out of the woods yet. You see, what we got is we got the SPY and the QQQ sitting right above the 200-week moving average. Now, could we come down and touch the 200-week moving average? Actually, we could. Now, if it happens, I'll be putting more money to work at that point. Right now, I am betting on this short covering rally I keep talking about. And maybe we've started. Maybe we hit the low last week and maybe this week is the start of the rally. We'll see. I don't think we're out of the woods. We could still come down and touch the 200-week moving average on the QQQ and the SPY. But there's just too much negativity in this market. Look at the hedge funds. They're all on the short side. A lot of the perma bulls, those YouTube guys, they were so funny. They finally threw in the towel, right? They threw in the towel. I think they're throwing in the towel at the wrong time. They sold all their stocks. They're out. I think we're going to get a big rally in the stocks. That's just my opinion. Now, we can come down and touch those 200-week moving averages first. That's possible. But we could also just take off and have the rally from here. We'll see how it plays out, but I'm betting on a short-term rally coming either this week or next week. That's just what I'm doing. All right, so let's move over to the real estate market. Now, real estate market, I mean, it's fascinating to me there also. You got people like Dave Ramsey, Sue Zorman, Barbara Cochran. They'll all tell you it's a great time to buy, that this is like the best real estate market ever. Don't wait, run out there and buy a house. Who are these people? What are they thinking? Okay, that's their opinion and they're entitled to it, but I have the completely opposite opinion. Look at when prices are at bubble highs, let's call it, and you got interest rates spiking, it means stay away, wait and see how this market plays out. Look at this market has never been more unaffordable. It's the most unaffordable market in the history of the United States housing market. And normally we get a price to income ratio. It's normally around 3 times. Right now it's up to 5 times. That's almost, it'd have to come about half off just to get back to normal. Look there's a mean line. We're way above it. We'd have to come back 50% just to get to the mean. And then if you continue, a lot of times it overshoots. We could go down 60, 70%. But this is just crazy talk, right? Because Mike, this time it's different. There's no inventory. Oh, there's no inventory. Inventory is starting to spike up again. You know what else is starting to spike up? Price reductions. Price reductions are now at 25% of listed homes have already had a price reduction. Now that's pretty close to normal, actually. I mean, I'm not really saying that 25% of listed homes is like an extreme price reduction number. No, that's pretty normal, but that's my point. The market is getting back to normal and it's going to start to come down because the interest rates are spiked up. The affordability factor is at a record high. This bubble has never been bigger than the 2008 bubble. I don't believe that bubble ever collapsed completely. They just pumped more air in the bubble by the printing of the money. They came out and they printed $10 trillion. That'll rise the prices of real estate. This time they might come out and print $20 trillion, raise the prices up, but I don't think it's going to work this time. I really don't. So where's the inventory sitting at? Well, we got 50 15 million vacant homes in the United States. Okay, that's kind of like a shadow inventory, right? We have over 1 million homes that are being built right now. We have new listings spiking onto the marketplace because people have a fear of getting out. They want to get out at what Billy Bob got out at. Billy Bob got out at the high. They want to get out at the high, and that's perfectly, that's normal behavior. Once they see these prices starting to drop, everybody's going to rush in to, get out of the market to sell their home. Look, if you want to get out at the high price, now's the time. I'm telling you, don't wait till September. Don't wait. Get out now while there's still some buyers, the laggards. Now, here's what happens in real estate, right? All right, so you get this big explosion in prices. Prices go higher. And they go higher in like the city areas, the main areas. Let's call it Denver. Let's call it San Francisco. Let's call it New York. And they go higher. Right? And then what happens is people, because that's where the jobs are, right? The jobs are in the city. But what happens is people can't afford the city prices, so they start buying the outlying areas. Very common. They buy the outlying areas and they drive into their job and they commute. They become commuters. Now, in the Bay Area here, we have people commuting from, Tracy's about, a couple hours away from Silicon Valley, but some people live out in Tracy and they commute to Silicon Valley over 2 hours each way. Now, that to me is just crazy, and especially with the price of gas right now, So these outlying areas, they're starting to crash pretty hard. They're starting to come down. They're already down 20%, let's call it. But it's getting closer to the city. The city's starting to be pulled down with it. But it starts in the outlying areas. And in your area, I'm sure your area is still up, but look at the outlying areas around your area. Are they starting to come down? If they're starting to come down, that's the creeping crud. The creeping crud is going to come and take your city down with it. It's going to take your area down with it. But okay, so we got 15 million vacant homes. We got 1 million under construction right now, and we got the listings spiking up already. But here's the other thing we got. We got foreclosures coming onto the marketplace. Foreclosures, right? Okay, now never in the history of the U.S. or anywhere in the world, I don't think, have people been allowed to stay in their homes and not pay their mortgages. Have people been allowed to stay in their homes and not pay rent? That's never happened before. This is new, right? But this is coming to an end. It's winding down. It's coming to an end. It was forbearance on the mortgages. Now, that forbearance lasted 18 months, and it ended about 18 months ago. So people either have to start paying their mortgages, or they have to move out, or they come and they get evicted, right? They get kicked out. They get foreclosed upon. And those homes are going to be coming onto the market also. Those are the foreclosure homes that are starting to spike up, that are starting to come onto the marketplace. But here's where a lot of the inventory is going to be coming from is, a lot of people think that businesses are going to come in and buy the homes, like BlackRock, like Blackstone. The investor's going to come and buy the home. No, that's already changing. Look at investors. They look at the velocity, how many homes are selling, and they see when the velocity goes down, they stop buying. Investors have stopped buying homes, and some of them are starting to sell their homes. Now, why do the investors stop buying homes? Well, let's take BlackRock and Blackstone, for example. They were getting 1% money, right? That's what they were getting. They were borrowing money from Fed Chairman Powell saying, hey, we need more money. And Fed goes, no problem, we'll give it all to you at 1%. Now, they were making, let's just call it the rough number, about 5% on when they buy the home and they rent the home out, they get a 5% return. So they're borrowing billions of dollars at 1%, and they were turning it out at 5%, and they were keeping that 4% spread. Well, here's what's happened. Now Chairman Powell's going, whoa, we got to tighten up the money supply a little bit. The housing market's running too hot. Inflation's running too hot. So we're going to charge you 4.7% is what they're paying now. 4.7% for, corporate bonds, corporate debt, about 4.5, let's call it. All right, 4.7. But let's say they can make 5. Well, that's really not a good return for them, because they could just take that money and put it into bonds, do nothing with it, and make a better return than borrowing the money at 4 points. Making the spread between 4.7 and 5% is like 0.3. It's just just not enough. It's not worth their time, right? So they are no longer investing in the market. Now, there's 20 million investor homes in the United States. Now, let's just say a rough number. Let's just say 10% want out. Okay, so 10% want out. That's 2 million homes that are going to be coming onto the marketplace. But who are they going to be selling to? Well, the investor's not buying anymore. So they're going to be selling to regular people, but this is going to bring the prices down because we have that affordability problem where people can't afford these prices. You know, when at 3%, maybe they could afford a $500,000 home. But you know, at 6%, they can only afford $300,000. So the prices are going to be starting to drop. You're going to notice it. Now, not in your area, of course, but in all the surrounding areas from you are going to be starting to drop. And this is going to put a lot of pressure on the housing market because the investor wants to get out. They were the one that propelled the prices higher. That propelled this bubble was propelled by cheap money from the Federal Reserve to the investor that went and bought the houses. Now it's going the other way. They're selling the house and because there's no cheap money, right? So it's changing is what I'm telling you. It's changing. If you want to get out, now's the time. If you want to get a good bargain, wait for a year, man. This takes time to play out. But, you know, if you hold off just to September, I bet you the inventory will double again from where we're at right now, that September through December window. If you're really desperate for a house, that might be a good time. If you have more patience, though, you're going to get a really good deal. This is just my opinion, of course. Now, I am a licensed real estate broker, and, well, maybe my opinion holds a little more water than the average person. I don't know if it does or not. It doesn't matter. Still my opinion. Anyways, it's Wednesday. Get out there. Have a great day, everybody. If you like this rant, give me a thumbs up. Why not? It's Wednesday. Bye-bye now.